Disclaimer. This material in this presentation has been prepared by ADCM, LLC DBA Willow, and is general background information about Willow's activities, current as at the date of this presentation. This information is given in summary form and does not purport to be complete. Information in this presentation should not be considered as advice, or recommendation to investors or potential investors, in relation to holding, purchasing or selling securities or other financial products, or instruments. Neither the information nor any opinion expressed herein constitutes an offer or a solicitation of an offer to buy or sell securities. Before acting on any information, you should seek independent financial advice. All securities and financial products involve risks. While due care has been used in preparation of this presentation, the information contained herein has been obtained from sources believed to be reliable, but its accuracy and completeness cannot be guaranteed. Forecasts and hypothetical examples are subject to uncertainty and contingencies outside Willow's control. Past performance is not a reliable indication of future performance.
All right.
So we'll just start here now with everyone.
We are going to go over some of our risk indicators that we typically do, and then sort of get into some of the pressing matters at hand. We got some really great questions that were submitted this time.
We love when you guys send questions ahead of time, because then we can like pull charts in and things like that that correlate specifically to your questions. So thank you for that. We encourage that for the future as well.
Right into our risk indicators. So we've been watching volatility pretty closely over the past several months. Really started November was when we first started noticing some uptick around here. It started to just creep up and has sort of been steadily going up since then. All the news in Ukraine caused some spikes too. Again, this is a measure of just what the expected moves in markets will be looking 30 days forward. So when this number goes up, it's saying that markets, or market forces in general, expect to see greater moves in the market over the next coming weeks.
Yeah, wider swaths. And again, it's the slope of the curve that matters more than anything else. So it's been an upward slope.
Right. And as you can see, over the past year, 12, 10, 9, 8 months ago, right? It's much more, this whole thing has been range bound, much more flatter. That to us says the status quo will most likely stay the same over that time period. But then when you see this divergence start to happen, this change in the slope, as Alexandra alluded to.
Change in the slope, and also like these lines, you see how many of these tops hit this top line. That's called the point of resistance. So when you see anything break above resistance, that's when you want to pay attention to it. So next one.
Final point. While it has come down from its highs, it's still trending.
Until we see that really resolve, then generally, we don't want to speculate for sure, but it looks to us that it's on the upward, still on the upward trend. Credit default swaps, this is good. At least we have a little bit of reprieve here. Always remember, we're going to talk about the fact that in markets, economies we view them as living and breathing mechanisms. So in breaths, out breaths, in breaths, out breaths, in breaths, out breaths, very normal. So you see this here with CDS. If this trend continues in the negative direction, great. We don't think so given the other indicators we're looking at. Bond spreads. Okay, in bond spreads, no real change here, just a little flattening. Just a little bit of a downturn in the last month here, but again, not our last week actually. So not enough to say, and by the way, this isn't enough of a change for us to even be concerned about credit yet.
Right.
Okay. So
this chart only looks at the 10-year too. And I know that there's been some talk of yield curve inversion happening. So this is sort of like that middle point of the seesaw. So it's the 10-year relative to
corporate bonds and stuff like that. Okay, so we had so we're going to dive right into some of the questions, because there were some good questions asked of us. And there was someone who asked a question. Can you get that?
Right. So the main question was, do you believe that this is a good time to look for riskier assets like growth stocks that have sold off, or higher yield bonds, bank loans, those kinds of things?
So Okay, high yield bonds and bank loans, no, because the Fed is just starting its move to the upside. So the last thing we want to do is be caught in a bond that has a low yield relative to where we're going. Of course, the Fed announced recently that they are not, that they have to get more aggressive on inflation. So when you're in an environment like that, you really don't want to be looking at the riskier assets. Unless we were to go like a 6-month term or even a 1-year term, we would consider ultra short, but not anything there. Now,
And just the idea there is that as interest rates rise, the prices of bonds go down. They're inversely related.
Yep.
So when you have the Fed saying, okay, we're going to consistently raise rates over the whatever time frame, all bonds during that time period, if rates are actually raised, well, even if they're not, because there's speculation that happens, but the prices will come down. So
yeah, the other thing is here's a really good barometer for you. That when you call me and tell me that you see your prices coming down, then we can have a conversation about this. But your own instinct, your own experience is equally as important as what we see here. So if you're actually starting to see that, oh, prices out there in my life are starting to look stable or coming down, then okay, then maybe the Fed will have to start pivoting. But the truth is, we're not having that experience yet. Just even as consumers. Yeah, let us know. As consumers, we don't see that yet, because you can also see, we didn't pull this in here, but the producer price index was really quite high this past month. That's the components that go into the finished product. So it's the raw materials, the materials into the process, and those were very high. So let us show you this chart. Okay, we'll get into that. Let's show you this chart. So this is to answer the question, is it time to go into risky assets? So one of the things that we do in our work is we want to watch for what we call a bottoming process. So when you have a very steep decline like this is Zoom. Zoom was at a high of 563. You can see here, it hit a low like in October of 2020 of 350, and it bounced all the way up to like 470. So you can see, look at this. When we say that, we look at markets as living and breathing. So out breath, in breath, out breath, in breath, out breath, in breath. This is very normal. What you want to see at the bottom is this consolidation like this. This isn't the bottom. We'll show you that in a second.
But you see how it's flat there, sort of stays along the moving average trend lines, and sort of sits there for the longer it sits there, arguably the stronger the breakout.
Yeah, and that's definitely been my experience. Yeah. Definitely my experience. So to answer your question about, is it time to get in riskier assets? Before we get into the macro, why it's not, we wanted to show you the charts. So don't be fooled by these bounces. And one of the things I said to Paul a couple of weeks ago is, Paul, don't be surprised if we have a really good bounce. That was before this run ran. And you're going to start questioning everything we did, because this is normal. We are in this phase of the market where we're retesting, but you can see this happen. So let's just show. So the answer is not yet. So let's go with the .com bust. Okay, so here's Intel at the high of 75, somewhere in there. Oops, lost my necklace. And it hit a low here of 35. So we're talking nearly 50%. And now it retraced back to somewhere around 47. So from 35 to 47, 12 points. We're talking 10, 20, 30% increase, out breath, right? Only to continue its downtrend for a number of years. So when this kind of damage is done, we expect this. We expect this. Here's another one. This is Cisco, same thing. High, low, and a bounce. Perfect 50% retracement. Perfect Fibonacci retracement of about 60%. Totally normal. That's the in-breath. That's the like, okay, we're good again. Let's buy again. Let's be exuberant, but only to fall apart. This is what we want to see. When we see this, I didn't pull that chart in, but in 2003 was the bottom, really, when you see this, and that's a multi-year that, consolidation, that is of interest to us. Now, charts aren't enough. It's really, we have one more? I didn't think I did another one. Did I? Oh, I did Juniper. Okay.
And
Well,
this
you can
one,
show that,
this
so
one
I'm
I
gonna
think
sneeze.
illustrates this really well because there's this huge 50% plus drawdown, and then the stock almost recovers 100%. Yeah, on a
Yeah,
percentage
with-
game,
yeah,
from
60,
100 to
70%,
160, 60, 70%
70%.
increase. But then, and that brings you to this right here, but that's still, much, much further. So you can have in these, I guess, bearish environments, or just when the trend changes, you can have these periods where there are these, what appear to be bull runs, or these massive growth, very short growth periods where stocks can go up 50, 60, 70, 80%, only to then continue on their journey down.
So now that's just the technical side of the market. So let's talk about like fundamentals. Oh, good. We're done with the presentation because we're just going to talk through this. So then you have fundamentals. So definitely the tech sector still looks very good. We still believe in automation. We still believe in AI. We still believe in robotics. Okay, that's there. But when you look at so that fundamentally, we still like it. But when the macro backdrop is going to be the dictator of where things ultimately go, at least in the near term.
And just to add, in behavioral economics, sort of the general attitude can always outcompete fundamentals.
Exactly.
Right.
And
regardless of how strong
Yes.
those fundamentals are.
Yes.
If everybody is, panicking or upset or confused or doesn't have the right information, doesn't matter how strong those fundamentals are, prices can continue.
The psychology of the market, just in the economy, it dictates. So what we see here, what we see happening is, so technically a lot of things don't look good. If you look at the S&P 500, many things are in the negative. But also what you're seeing is that there is some chinks in the armor in terms of the economy. So as long as the Fed is in a rising rate position for a while, we don't know how that's going to go. And we are starting to see some slowdown in certain sectors of the economy. So housing, if you saw the home builders are less confident than they were a year ago. These tend to be very, decent leading economic indicators. So we rather be, again, right now, and we've said this before, a little bit more to the air of conservative, especially when we have a geopolitical situation that we don't know how far this can go at this point. That's of deep concern to us, is that particular. And I think that's the next question. Does Russia's invasion of Ukraine hurt the outlook for tech sector? I think it hurts the outlook for everything, because
it introduces the invasion really introduces uncertainty
and externality.
and at the end of the day, markets hate uncertainty. The more uncertain they are, the more volatile they get.
And there is some truth that, someone did ask the question, wartime tends to help the markets. Okay. We want to talk about this because this is very important. We've had, as you know, some wars over the last couple of years, Iraq, Afghanistan. And when we went in and invaded and did our thing, markets bounced. And it was the catalyst to a greater rally. We are looking at a very different situation than something as, I don't want to say, we're looking at Russia, we're looking at
the potential for something like the Iraq war to escalate into something much larger was very, very small. But the potential for Ukraine and Russia to escalate into something much larger that pulls other countries in, it arguably is much higher than.
So we view the geopolitical risk a little too high right now, as well as the Fed being in a more aggressive interest rate environment where they want to raise rates. And you are seeing some, technical breakdown without a questionable doubt in the markets. We need to see a period where that slows, that sideways trading takes place. And we know that the Fed is going to be close to done with what they need to do, and that's not happening at this point.
The past decade plus has been the mantra was always, buy the dip, right?
Mhm.
But when you look at the backdrop during that time, it was easy money from the Fed. There weren't these risk of global conflict. Supply chains were running smoothly. There wasn't the supply chain disruption that we're experiencing today. There are many, many factors that are significantly different today than they were for the past decade or so. So to us, that says one more reason to just be cautious currently and sort of, okay, let's see how this stuff plays out. Maybe it'll go back to how it was. We'll see.
Yeah, and that's why we definitely, so asking the question about growth stocks, that's why we favor value stocks. And to get to your next question about where to find income, I mean, the value stocks, such as utilities, I mean, we haven't bought a utility in a while besides NextEra, which was more growth oriented some time ago. But now the utilities look more interesting to us. You see that we've taken a position there because there is, some income associated with it. It's got a lower beta. It's considered a value stock. It's not considered growth. Too much out there for the growth stocks. We want to own things that we know, you're going to need to pay your electric bill. You have no choice, but you really do have a choice whether you go out and buy another Apple phone. You do. You can make this last longer, but you really can't. You do have to heat your home. So really sticking to that theme of what do you need, what do you have to have. The other thing is there's massive consolidation in certain industries. Like really, you're starting to see big consolidation in insurance more now than ever.
Yeah, Berkshire Hathaway just bought Allegheny. A huge insurance company.
And you're seeing more and more of that. So that's an interesting place, I think, in the longer term, where you're already seeing, fees go up, for insurance. But that to me is an area that it is in heavy consolidation, and I think that will continue, and that keep insurance companies pretty well, I think in pretty good shape. So it just depends upon which insurance company, which lines it's in. So that's, again, another value-oriented company. We're less inclined to be involved in financials like banks right now for a number of reasons, mainly interest rates, and more so the concern of how fast the Fed wants to ratchet up rates now and the potential for delinquencies. That's bothersome. So the next senior loan survey is due very soon, so we'll have a good idea how things are going at that level. So next question.
Energy.
Yeah. Oh, energy is the other, the other value-oriented area. So it's not time to look as when you look at Zoom and it's down, I don't know, like
70 to 80% or something.
Yeah, it looks interesting, and Spotify. I mean, some of these things that have recurring income are definitely interesting. Though Zoom they had a problem with their earnings because people are going back to the office, so less subscription for Zoom. So anyway, so that's that. Oops. Go ahead, Paul.
Yeah. So one of the questions we had goes back to earlier to just briefly explain what credit default swaps are, or CDSs. And basically, the main way to think about those is that they are insurance on a company going bankrupt. So if a company if the chances of a company going bankrupt increase, the insurance on it gets more expensive. And that's what those CDS spreads measure. So when CDS spreads increase, it's saying, oh, the underlying risk of this company going bankrupt is much higher. So these CDS spreads, so the credit default protection costs more.
And they're nowhere near the levels they were in 2007, not anywhere near. So right now, there's no major signs that there's credit risk. So let's, kind of go back in history a little bit. So the recession in 2000 had more to do with the productivity gains that we generated through technology in the 90s. So because we had productivity gains, we had a lot of unemployment. So that was really based just simply on, the employment situation and productivity gains. Fast forward to 2007-08. So there wasn't really there were some credit issues, but it was like, companies like Ponzi schemes like Enron and WorldCom. And so some of the bad actors, the bad players were being ferreted out because yeah, it was a recession, things were getting difficult, credit was difficult, but not like 2007-08, which was really a financial crisis. So that was really a financial system in absolute stress, very different. We don't know how this, like we're saying, maybe we're going to go into a recession. I think, you know, we've been saying we're probably going to hit more of like a stagflationary environment. We don't know for sure how this is going to play out. So we just have to let the data show us, and it will continue to show us. It will show us over a longer term time frame. So that's what we have to just wait for the proof, so to speak. So here's this question about, would investments in cybersecurity stocks be attractive at this time? We love cybersecurity, but again, to Paul's point earlier, it almost doesn't matter what the fundamentals look like. You know, right now we look at the market as taking the in-breath. You can see it's going higher. It's been going generally higher over the last couple of weeks, I think, at this point, right? Yeah, so we want to just let this play out. And especially the person asking this question, you're a veteran, you know how this goes. You've seen it before, you know? So, but cybersecurity, I mean, there's a lot there.
Yeah, there's a lot of stuff in the tech space that
look amazing.
We love it,
right?
but
yeah.
it's just a question of now's not the best time to be getting into it.
Okay, so the next question. Have you considered investments in long-term equity anticipation securities? So leap options, which are long-term options, as an alternative cash. Yeah, I mean, we would consider leaps if we felt that we were closer to a bottom of a market. We may consider those on the long side. So more calls I would do than puts. So yeah, but that's a strategy too in and of itself that, you know, takes really to make money or to do well in it generally takes somebody to be able to focus on that. Yeah, it's not our thing. Let's see what other questions.
There's a question about.
Yeah, let's go to the next. So,
yeah, so there's an interesting question we got about if home builders are becoming wary of building more, doesn't that raise prices on existing properties? And the housing market is really interesting in that it generally moves in one direction, but it's really location based, number one. But number two is that there's so many different factors that impact it, right?
Prices.
From material, and those are determined partly too by supply chains, which are all messed up right now still. So you have these broken supply chains that lead to increased costs. You have the Fed raising rates, which in turn increases like the 30-year mortgage rate. Mortgage rates goes up, which again brings down prices, but also might pull some potential buyers out of the pool too. I would say housing's
so not necessarily like the home builders are responding to what they're experiencing as a slowdown in demand. Okay, they don't just pull out of thin air. Oh, we're suddenly not confident. They are basing this on their back orders, like what they're seeing, like what's coming in, what kind of inquiries they're getting. So generally,
those factors have been projecting forward. Okay, given that this is the current environment, what do we expect going forward? And that keeps sort of getting worse. What the current environment is.
Yeah. So generally, in history, when home builders aren't confident, generally that's when you start to see a slowdown in home. That's where you start to see, I don't want to say bust cycles, but that's where you start to see the dips come in. This is a little bit different in that material prices are still very high and not coming down. So again, like lumber prices started to come down and now only to come back up. Now we're going into the springtime. So even if demand starts to fall off in the home builders, you're still starting to see the prices come back up in raw materials, which is very difficult. So yeah, and the other assumption you'd be making here is that the home builders aren't getting demand, that the demand still exists for existing homes. That's with rates going higher, that's likely not going to be the case. Okay, what else? Or 30 minutes. Do you have, if you want to write in the chat, you can. If you have any questions, that would be great. Meanwhile, just let us give you a little bit of a backdrop on where we are right now. We still have a fairly decent cash position in the portfolio. This is why I told Paul a few weeks ago, this is his first time experiencing. We think we're going into a bear market. So this is, whether we do or not, I mean, the charts are showing us we're in that direction. This is his first time in his career, actually, where he's experiencing a potential rollover.
Change in the cycle.
A change in the cycle.
And, I mean, way to think about it too is everything moves in cycles.
Yeah.
Right.
Yeah.
Everything moves cyclically, and historically, when you look back at the market, we are due for a change in the cycle. Now, whether that is going to be months from now or a couple years from now is to be determined. I mean, arguably, it's already happening. But it's happening, right? Something is changing.
Yeah, and the good news is that the areas where we're focusing on are actually doing pretty well. So like energy and utilities and staples, and overall those are doing pretty good. So that's been really good for us. You can also raise your hand if you're interested, or you can write. You can type in the box. Okay.
Steel stocks.
Okay, so this is great. I'm glad you're asking this question, because again, you have to assume that building is going to continue. Steel stocks can do well, and if there were an acceleration in war, this has definitely historically been the case. But we find with basic materials, it whipsaws. So basic materials can have really big runs and then just get slammed back to planet Earth very quickly. In fact, we are looking at a basic material stock for the portfolios. It is a potash company. We actually spotted this about a month ago, but it took us some time to do some research, because a lot of the potash companies that I used to know all got bought out, and we didn't want to look at something micro cap for you. We did find one, but subsequently it had a huge run in the last couple of weeks, I think. So we have to wait for that to have some proper pullback. But to your question, steel is in the basic material sector. It's not an area that I would feel comfortable being in a rising rate environment. Potash, because it's for farming and food prices are going higher, and you need food, okay, this is something that definitely interests us. So, and there's a shortage with the war in Ukraine now. You're seeing a shortage of
Russia and Ukraine account for 30% of the world's wheat and a very decent percentage to a fertilizer. So those will have effects, but they take, I think it's about 90 days or so before those effects really are felt. So something we're keeping an eye on.
Yeah. We did not put the charts in here, but when you do look at what's going on with the supply chain and shipping, it's still problematic. We still are having a hard time getting shipping containers into the country. The prices are still extremely high. We don't know, like the chart is really been parabolic. If it went down a little bit in this last month. We don't know if that's the beginning of a downtrend or if that's a topping process. It's too early to tell. But the externalities exist still, that there's a problem. Now, what we see happening is some airline companies are moving to becoming cargo companies. They're actually changing out some of their planes for cargo. So what that means exactly, we don't know, but we see that that's starting to happen there. What's this? A Bitcoin and Ethereum. Okay, so the question is, at what point do we really know if Bitcoin, Ethereum really have long, strong standing? So many people think there are no legs.
Yeah, well, I mean, I would argue they already do. When you look at companies like Visa and any of the Fortune 500 companies, really, Nike, all of Walmart, they all have blockchain divisions that are, come based off this technology. So
Yeah, so what we're seeing, to answer this question, what we're seeing happening in the market right now is we're actually seeing more and more companies putting more money into the infrastructure to participate in the digital asset space. So
the global payment providers are building the infrastructures, the rails, so that they can handle transactions on these networks and then connect them to their already existing clients and facilitate these kind of payments on their networks, but tap into the Bitcoin.
Yeah, here's something really important, and I'm going to say this as somebody who's like not in the younger generation. Remember, it's really, there's a shift that's taking. This is a big deal. There is a shift that's taking place. We didn't grow up with these in our hands, okay? But this younger generation is far more technologically advanced than certainly my generation. They are used to digital transacting, and so really, if you look at the demographics are there for this to come online. So it's not just that, we see large companies putting money into this, money into the infrastructure. We see, like Paul said, MasterCard, Visa, the large banks putting in rails so they can start making payment on these systems. If it's not viable, that would not be happening in our opinion. What will make this more viable in the long run, we think, is thoughtful regulation. If we can have thoughtful regulation, which we are a proponent of, okay, that would make this sector more viable in and not that it's not viable now, but it would, I guess, add credibility to it.
Well, it would remove a lot of uncertainty and allow for a lot more innovation to thrive if it knew the sandbox that it could play.
Exactly.
Right. So if you're a tech company and you want to experiment with some of these things, but then you accidentally did something that broke some absurd or really unthoughtful law, you're not going to do that, or you're going to move your business to a country that allows that. So if the US was to come up with a good framework for regulation to allow people to really innovate and try different things out without fear of regulators coming in and basically destroying them, they're going to do that. And thoughtful regulation can really lead towards all types of innovation.
Yeah. So the next question is so then how is that going to impact the value of the dollar, or is there no relationship? Too early to even tell if there's a relationship. The dollar, the bigger concern that we have about the dollar is, the impact of what's going on globally and the US being a reserve currency. If that were to change because of whatever is transpiring, that's going to have a greater effect on the value of the dollar.
Yeah, we've talked about the US reserve currency and the value of the dollar in general over the past decade plus, that it was going to be threatened at some point, and it is going to lose clout over time, arguably with, basically, and I'm not taking any moral ground here, you could say it's right or wrong, but removing Russia from the SWIFT network, excluding them from the use of the dollar, essentially freezing different people's dollar assets. If you're a country who's not the US and you have amassed a bunch of wealth and you see that the global standard has been this dollar, and it's like, okay, I know it's safe. I know I can put my country's money in this, and that it's going to be liquid and I'm going to be able to access it. All of a sudden, those assumptions are no longer true, where, wait a second, this asset, I might get freezed out. As a country, you might be starting to question, is this the smartest place for my money? What that ultimately does is undermine the US dollar's status, which is highly concerning. And just one more swing at.
And here's the other thing, we don't have a chart, but we'll bring it in the next time we do this. And we've shown this chart before, is the dollar over a very long period of time. So if you're looking over at over the last 3 decades or 4 decades, you would see that each time there's been an externality that's been significant, like 9/11 or going to war with Iraq or agent contagion, whatever it is, you would see that the trend of the dollar is to the downside. But every time So the dollar is considered the safest asset in the world. Now, every time there's an externality, the dollar would rally, but never to the high that it rallied the last time. So it's, and even with what's going on in Ukraine right now, the dollar hasn't even come close to where it was trading at the last peak. So what that says to us is the luster of the dollar as the safe haven to be is losing its luster already. So it really doesn't have anything to do with the cryptocurrencies. And I think
other than that, cryptocurrencies might present as a viable alternative.
Yeah.
Down the road or something.
And maybe that, and then, I think it more smacks to the fact that we may be coming off of paper assets and then more into digital. And so that would affect a whole underbelly of economy that's running, the gig economy, so to speak, that's running underneath the surface. Any other questions that you folks might have? Because we don't see any more coming in yet.
All right. Well, we can wrap this up then.
Yeah.
And if anything comes to mind, feel free to shoot us an email, give us a call. You know where to find us.
Yeah. And if there's things that you want to see in the next, don't just, call us with questions or email, but if there's things that you want us to see, things you want us to drill down into, please let us know. We'll be doing a cryptocurrency update, I think sometime next week. But you right next week? Okay. So, but if there's anything else that you want to see, if you want us to break things down, whatever, please let us know that, because this is for you. We do this for you. So, okay.
Feedback welcome.
Yeah, please. Okay. Thank you, everyone.
All right.
Be well, everyone.